Elf Beauty used to be one of the best performing stocks of all time. Retail investors, they love the company. And I got asked about it a lot. It's down over 66% from all-time high. It's been a disaster, down over 40% just in the last months alone. The market has been killing the stock. And I decided to talk about it, as many of you guys have asked me about it. You asked me about a lot of stocks like Celsius and many others, and I'm going to talk about them. But I just don't do any stock reviews before earnings, especially if I did one a few months ago, because everything in between earnings is mostly noise. So I try to ignore the noise and I talk about after earnings in case the fundamentals or the thesis has changed. But I did talk about ELF before. I said ELF is an amazing company that's still growing 20%. I said 30 times earnings isn't cheap. I would wait for under $100 for some margin of safety in case the growth deteriorates further. And this is exactly what's happening to Elf Beauty, and I'm going to talk about it. Now, if you're not familiar with the company, Elf Beauty has a lot of skincare, a lot of makeup, and many different things that a lot of people use. And they're very well known for having decent kind of quality for a very low price. So if you're someone that you don't want to spend a lot of money on skincare or whatever, but you want something that's decent quality, Elf Beauty is the choice. Elf Beauty has taken all over the shelves at Ulta Beauty, at Walmart, at all these kind of stores. You see Elf Beauty everywhere. Tens of thousands of reviews on Amazon, and it got very popular out of nowhere. It took market share from the big brands, and this is Elf Beauty. And Elf Beauty is suffering from one of the worst things a growth company can suffer from, and this is decelerating in growth. We saw what happened to Celsius, we saw what happened to Estee Lauder, we saw what happened to Nike, we saw what happened to a lot of those growing companies. Once the growth starts going down, the market just kills the stock. The stock just gets killed. And Enphase and others, Solar Edge, especially if the stock is priced to perfection. And this is what happened to Elf Beauty. It went from 5% growth, 12, 23, 47, 76, now 27, expected to go to 11% in next year in 2026. And the stock was priced to perfection. It was like, was it 50 or 60 times earnings or something crazy for a makeup stock? That's unheard of. So the stock was also priced to perfection. In terms of the latest earnings report, they did miss on earnings per share estimate, 74 cents versus 75 cents expected. Revenues, they beat, slight beat, so it wasn't too bad at all. But guidance is really what killed the stock, because they're seeing earnings of 66 cents to 71 cents during the first quarter, and the expectations were 97 cents. So this is a massive, massive miss. That's why the stock went down 27%. And I'm going to talk about if this is actually justified or not, because sometimes stocks do go down 27 or 30%, but maybe they're still overvalued. And maybe that's the case with Elf Beauty. In terms of total year earnings, they're expecting 327 to 332, and the estimate was 354. So this is way below the estimates, and it's really, really bad. For the second half of 2025, in terms of sales growth, they're expecting 14 to 16% in the second half. This is a massive deceleration in revenue growth. We look at the P/E ratio. It's now trading at 21 times earnings. Now, before I get into my valuation model, I'm going to be honest with you guys. If the company is only going to grow 14 to 16% in sales from here, and if net income margins did peak, and I believe there's a very high likelihood that the net income margins have peaked, which means earnings per share isn't going to grow much faster than revenues. They're likely going to grow together. Meaning, if from here they only grow sales 14 to 16%, 21 times earnings is not a bargain. Again, I'm just being honest here. 20 times earnings for 11, 14, 15% revenue growth or earnings per share growth for a company with 13, 15% net income margin, it's really not something that's a bargain. It's not something I'll put my entire portfolio in, but that's just me looking on the surface. Now, for my valuation model, if I take their own estimates, their own guidance of $3.33, I put it in this compounded growth calculator for the next 4 years, because this is 2025, so I'm putting the 4 years after that. That would give me a 5-year outlook for earnings per share, and I'm putting an interest rate or earnings per share growth of 14%. And I personally believe 14% is highly achievable. As the company is decelerating in revenue growth, 14 to 16% in the second half, and you have, again, I believe net income margins have peaked. And the company isn't buying back shares, it's actually diluting stock 3 to 4% a year. So the earnings per share growth is going to be 3 to 4% lower than the potential 14 to 16% that I'm pricing in here. So I believe 14% earnings per share growth is more than fair for the company from here. I'm not saying it's not going to get to 20, 25%. It's possible. But generally in the market, it's extremely dangerous to bet on a company that's in a downward trend in terms of growth, and you betting that the stock all of a sudden is going to re-accelerate in growth. This is very dangerous. People have been betting on Nike for 3 years. It still hasn't happened. Estee Lauder, almost 4 years. It still hasn't happened. This could take much, much longer than most of you guys expect, and it's a little bit dangerous. 14%, we get around $5.62 per share in earnings per share over the next 5 years. For a PE ratio, as I told you guys, if the company is growing earnings per share 13 to 14%, 21 times earnings is more than fair for the company. Now, if it does reaccelerate, it could go back to 25, 26 times. In terms of ELF going back to 40 times or 60 times, I would highly, highly doubt it. It's not impossible, but it's highly unlikely. And if we want to value ELF on the mid to worst case scenario, or a base case scenario you want to say, I would take my estimate of $5.62 and I would time it by the current PE ratio of 21 times forward earnings, which I believe is fair. We time it by 21 times, we get $118 per share price target over the next 5 years. The current price is $73. So if I divide it by $73, this is 61% on the upside over the next 5 years with ELF Beauty. And this is really not a bad return at all from here, because maybe earnings are going to reaccelerate, maybe something more fancy happens. But from a worst case scenario, I'm seeing 61% on the upside. Now, a lot of you guys know that I like to normally double my money every 5 years or get a 15% CAGR. If I'm trying to do that with ELF Beauty, I would have to buy the stock around $59 or pretty close to $60 per share. And I know this may be unlikely and maybe it never happens, but I'm just using numbers, and numbers don't lie. And the way I value stocks, the way I look at everything, using 14%, using 21 times earnings on a base case scenario, to me, ELF Beauty here could be a good setup. But is it the best setup in the market? I would say no. Is there better opportunities? Yes, and I talked about them in my video just a few days ago and many other videos. So I believe ELF Beauty here is a decent opportunity. I'm not ignoring it. I'm not saying it's not a good buy, especially if you're willing to take some risk. But for me personally, the way I'm running my numbers, ELF Beauty, if it goes to $60, it's much more interesting. If it doesn't, then it's fine, and there's better opportunities in the market. That's just how I look at stocks, and that's how I look at them. I don't FOMO. I don't feel like the fear of missing out. A lot of you guys tell me it never gonna get to your buy price. Google got to my buy price. All these stocks, ASML, I bought at 652, and many others. So for me, I just do my valuation model and I wait. If it gets to it, then I'm fine. If it gets near the price, I'm gonna buy it. If it doesn't, then it's fine, and I just move on to another one. So that's how I do it, and that's just my strategy, and that's my opinion on ELF Beauty. It's not bad, but it's not the best opportunity in the market, in my opinion. Again, I hope you enjoyed it. Not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.